We think FAANG is unlikely to lead the next tech bull cycle. We are less exposed to FAANG than we have been since the acronym was introduced.
In the past few months, tens of thousands of tech workers have been laid off, with even pandemic leaders like Amazon. There were at least 154,000 layoffs from more than 1,000 tech companies last year. It has continued at a fast clip in 2023, with more than 26,000 layoffs recorded so far this year. Big tech stocks have taken a hit. Revenue growth rates have started to slow. What does this all mean about the state of the techs? Are we looking at years of a tech bear, or is this a fleeting setback? And are you going to buy the dip? Before you do, please watch this episode. This is V-Circle Future. Mass layoffs in tech have occurred more frequently throughout history than one might expect. To better anticipate what may lie ahead, it may be useful to examine past events in this regard. During the early 2010s, the tech industry was able to thrive thanks in part to the Federal Reserve's post-recession policies, including low interest rates and quantitative easing, which injected a significant amount of capital into the U.S. economy. Tech companies were able to access patient capital from investors due to the low interest rates at the time. Tech stocks known as the FAANGs, Facebook, Apple, Amazon, Netflix, Google parent Alphabet, and Meta have played a leading role in the shift to a digital world and contributed to a 13-year bull run in the market. The outbreak of the coronavirus pandemic in early 2020 had a significant impact on the stock market, but indices quickly recovered. Large-cap tech stocks also played a key role in this rebound as consumers who were confined to their homes turned to online platforms. The increased use of these tech products and services helped drive the recovery of the market.
Companies faced a once-in-a-lifetime opportunity during the pandemic, one due to very favorable conditions, with very low interest rates, free money everywhere. Even more importantly, there was a business opportunity that came from people being forced to stay home, stop shopping in person, and stop going to sports events and concerts. So, it made sense that those companies lean into that moment heavily and make a big investment and capitalize on that sort of leverage to appeal to even low-propensity customers.
As a result of the optimism surrounding the tech industry's growth prospects, headcount at tech firms rapidly increased, as they hired not only for current growth but also for future growth. This expansion was fueled by overly optimistic projections that did not come to fruition, a common occurrence in previous tech bubbles. When inflation spiked and the Federal Reserve raised interest rates, the cost of growth increased as access to capital became more expensive. The industry is now returning to a more realistic outlook and realizing that they may have overhired. One key distinction between the current round of tech layoffs and those of the past is that the current cuts are primarily precautionary in nature.
It's a lot more preemptive this time. In earlier cycles, they would have let it run another 2 or 3 years, or at least a year even. However, this time they're pulling off the band-aid way earlier than they would have before.
Why did these big tech companies lay off workers earlier? The Federal Reserve's rate hike and the weakening economy may appear to be the cause of the early layoffs, as it can put pressure on companies' profitability and increase their costs of borrowing. Some people may argue that FAANG has a wide moat and is still leading the industry with advanced technology. Additionally, the 5% increase in interest expenses did not erode the company's total profits. Yes, partially correct. But we want to say, this time might be a bit different. There is an invisible rule in the market. Industry leaders from one era do not often maintain their dominance in the next. There are early indications that this shift may already be underway, as the growth of companies like Netflix and Meta has slowed or stalled, and the size of companies like Amazon, Apple, and Alphabet makes it unlikely that they will achieve the same high returns as they have in the past. Goldman Sachs predicts faster than benchmark growth in tech stocks over the next year and 2024, but smaller than average over the past decade.
It's very difficult to grow these mega revenues at very high growth rates like they've done in the past. While mega cap stocks have held up well, going forward it's hard to see them necessarily driving performance from here.
Meta's shares fell by a quarter of their value in a single day after the company's fourth-quarter revenue guidance came in below analysts' expectations due to a slowdown in the advertising market. The stock has since plummeted 66%. Amazon's shares also fell 7% the following day after forecasting its slowest holiday quarter growth in company history, and the stock is down 30% year-to-date. Apple, the world's largest company with a market value of $2.3 trillion, has performed the best in this year's bear market, falling 20%. Netflix has declined 50% for the year, and Alphabet has plummeted 36%. The combined market cap of these 5 stocks has lost more than $3 trillion since November highs. From an outside perspective, this wouldn't be that bad. Despite slower growth, many investors still believe in the sustainability of big tech companies and continue to buy their stocks at dips. However, it is important to understand the implications of lower growth before making any investment decisions. Okay, here is the point. If big tech companies experience a slowdown or start to stagnate, they may not be able to offer attractive stock options to employees. This could result in unaffordable shareholders dilution. Why is that? We need to understand the underlying mechanics of big techs. Flying business growth leads to increased salary packages and stock options for top talent, which in turn supports further business growth. However, these mechanics would be broken if the company does not grow. For example, consider Meta. After its drop, it is now valued around $350 billion. Assume Meta 87,000 employees, before layoff, each had a $100,000 stock option plan, which is equal to $8.7 billion in stock options. This is close to 3% dilution. This becomes a serious issue for shareholders if Meta does not grow for the next 10 years. Assuming a 3% dilution rate over 10 years, the total dilution would be 30%. When factoring in inflation, a $100,000 stake in Meta may be worth less than $50,000 after 10 years. This would be a disaster. To compensate, big techs may have to lay off more employees or reduce salary packages, making them less attractive to top talent and hindering growth. It's a downward spiral. Tech stocks are expected to face continued challenges in the coming year, with analysts predicting a 1.8% drop in earnings for the industry compared to an expected 2.7% growth for the broader U.S. market, according to data from Bloomberg Intelligence. This suggests that the tech sector may underperform the overall market in the coming year. Right now, you have to keep it in mind. The world has changed.
2 years ago we could have thrown a dart at a FAANG dartboard and pretty much won, right? For the following years, that will probably no longer work.
So what's changed? In Howard Marks' latest memo, he said,
We've gone from the low-return world of 2009 to 2021 to a full-return world, and it may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return targets. Lenders and bargain hunters face much better prospects in this changed environment than they did in 2009 to 2021. And importantly, if you grant that the environment is and may continue to be very different from what it was over the last 13 years, and most of the last 40 years, it should follow that the investment strategies that worked best over those periods may not be the ones that outperform in the years ahead. That's the sea change.
As borrowing costs increase and inflation rises, investors are becoming more selective in their investment choices. The capital is no longer patient. This shift can be attributed to the fact that
the market wants short-term profitability and cannot afford to fund all of the negative free cash flow. Get a little more realistic, grow a little slower, but do it profitably.
Large capital projects in untested technologies, such as Meta's bet on the metaverse, will struggle to attract support. This may have explained the significant decline in Meta's stock price last year. Another quick take is the way you evaluate the company. For example, comparing the company's ratio to the average of the past 10 years may not provide as much helpful insight as it once did. Additionally, the current economic climate and other external factors may be impacting the validity of such a comparison. It is therefore important to review all the relevant data, both internal and external, to gain a comprehensive understanding of the company's current position and outlook. Who will lead the next bull cycle?
Right now, these big tech companies saw what survivors did after the dot-com bubble and the Great Recession, so they're sitting on piles of cash and doing layoffs now so they can come out swinging once the dust settles.
Ultimately, the question isn't whether the big tech will rebound. It's what the next big innovation will be that drives and shapes that rebound profitably. Cloud computing, AI, metaverse, etc. It's a massive wager on the future, and big techs or newcomers are determined to fight tooth and nail to make sure they come out on top. They know that they must take risks and be willing to put in the hard work to ensure their success, but they also understand that these risks can pay off in a big way. We will keep track of the market, conducting an in-depth due diligence evaluation for each company later. This is V-Circle Future. Thanks for your watching.